fantastic webinar for you today. And particularly given how difficult times are in politics and economics, the markets are pretty easy. All you have to do is sit back and not panic or get bored. So let me know you can see and hear me. Don't be shy. Start chatting, as they say. And we're kicking off. So as you all join, we see the attendees joining. Just let me know where you're from. I've got David, Adam, got another David, Ian, Barry, Roger, James, Mitchell, William, Chetan, Mark, Jim, Joy, Jitin, Glyn, and so many more of you. I won't name you all. Let me know where you are. And let me know as well as where you are. God, I hope I've not turned off the chat. If it's your first time on the webinar. Okay, so either way, let's get on with it. Let's share some screens with you. Turn screen share on. Here we go, and I'm looking at the screen. So this is what we're going to do. It is part of my campaign for 1 million to teach 1 million people how to be better investors. As I always tend to do. Oh, we got Raj from Leeds, Glyn from Wokingham, Chitan from Leicester, Anu of your jealous GM. Nope. Glenn from Bognor, Fulham, Newton, fantastic. Right, now, first things first, let's start off with some of the politics. Before we do that, just so you know, this is not a solicitation to buy or sell any individual security. It is not individual financial advice. Can you believe freedom of speech to one side? All of those things would be illegal to do, not least because I'm not speaking to you individually. I am talking to you from a distance. I don't know you personally. So let's start off with some of the broader political stuff going on in brief outline. Okay, UK interest rates have fallen. The speculation is the Americans will reduce interest rates 3 more times. I didn't think the global economies were in that much trouble that we needed to reduce interest rates. I'm glad we are. More money in the system. Stock market keeps going up. But it seems a bit curious, just all this market focus on cutting interest rates. Okay, but nevertheless, I'm sure nobody's complaining, particularly homeowners. Of course, savers might be, but homeowners won't be. Gold rocketed because of the speculation that Trump was going to put tariffs on gold imports into the US. As I said earlier in the week on my TikTok and YouTube videos, I think it's about time to start shorting gold. Pretty useless metal other than in catalytic converters. So it's getting a bit out of hand now. But then again, I'm not a gold specialist. So I think we've had the run, and that's about my expertise on gold. Are we going to get an oil price shock? I don't think so. I don't think what CNBC said is if the Indians go and buy in the open market, oil goes to $200. They're not going to do that. They're not stupid. And they're not going to cause an economic shock to the rest of the world. They're not the Middle East of the 1970s. It's not the Indian way. So what are we left with? I don't think we're going to get an oil price shock. So that's fine. Regarding Ukraine and the Middle East, and this is really all I'm trying to relate everything back to the stock market and making money. It's not general pontification about the markets. Ukraine, there will be no peace deal, obviously. I'd rather put my money on the KGB officer than the US president. I'm trying to think of one since the Second World War where I would put my money on the US president over a KGB officer. Anyway, there'll be no Ukraine peace deal. There'll be no Nobel Peace Prize for Trump. My God. And Trump always chickens out, as he's done with the Chinese. So that in game theory economic terms, Trump has no credibility. The threats don't stack up. And if your threats lose credibility, then you lose authority and you become irrelevant. Okay, so it's basic economics. The market gets it. And now, because he can't cause those shocks to the market that he caused in February, the market's excited that, oh, great, we can't have the president mess it up, or any politician mess it up. So that's good for the market. Those flip-flops will continue. As far as the market's concerned, he's irrelevant. He's removed out of the equation, which is good for the market. And his big, beautiful bill, which Elon Musk hated so much, and Trump hates Elon Musk so much now. So either Trump's got a problem with relationships with countries and individuals, and wives for that matter, or his big, beautiful bill is also fueling stock market rises, which is what the view is. It's basically fiscally loose, as they say. In other words, lowest taxation and increases spending. So guess what? Good for the stock market. S&P 500, therefore, at all-time highs, as we will see. Gummissel, I know it well. I went to Full Net Boys School. We had a lot of students from Gummissel that went there. Now, here's a headline I saw today. I want to take you through this. This is the important bit. Goldman says it's time to play the meme stocks again. Now, that's August 13th. That's today. Okay, it's the time of the recording. Now, why is that interesting and shocking? Well, first of all, Goldman Sachs talking about meme stocks. In case you don't know what meme stocks are, those are the stocks that retail investors plow into for fun. Okay, they speculate, they gamble. Here are some of the names. What is absolutely extraordinary is that the mighty Goldman Sachs is talking about it. But I tell you what's worrying about this. The Goldmans are really inviting their own clients to speculate like retail clients and play around with meme stocks. Okay, look at what they've said. This is literally what the Goldman Sachs analyst has said. Marshall recommended clients buy call options, so add derivatives on top of the momentum in these companies coming out of retail clients' meme stockedness. Now, that makes me think that Goldman's want to increase brokerage revenues, make headlines. And this is just insane. They're inviting you to gamble. This is not a webinar on trading and speculating. This is about investing, which means holding for a slightly longer period. I can do one on trading and all the rest of it if we want, but this isn't it. Okay. And it's very tempting for retail clients to gamble. Nobody gambles the way a retail client does. They love it, and they're doing it with the stock market through Robinhood, if you remember, and all the rest of it. Now, I don't mind if somebody says advanced micro devices, I want to hold for the long term, I invest. But trading around these names, well, good luck. It's tempting for retail clients. I'm saying don't do it. All right, don't do it, even if you hear Goldman Sachs talking about it. It's really getting ridiculous. And by the way, this is the journalist headline from CNBC. So you've got the journalists who are trying to hook you in, amplifying the messages from even the blue blood banks, or the bulge bracket banks, who are meant to be a bit more sensible. That noise is going to get retail clients to go nuts. Okay, it's that. Just sit back. Don't get bored. Don't panic. Don't get greedy in FOMO. If you want to gamble, go to Ladbrokes. All right, go to Vegas, like this guy is. Here are some other headlines I want to discuss with you because they're bang up to date, and I think it's going to improve your investing and your mindset. Citigroup raises S&P 500 forecast thanks to strong earnings. Nothing wrong with that. Tax bill benefits the U.S. Congress. I used to work in the U.S. Congress 30 years ago. Can you believe it? 30 odd years ago. Still feels like yesterday. Now, Citigroup are raising their forecast. That's fine. JP Morgan Private Bank had an event recently I was invited to. They've done the same, and they're telling their clients, and that's for real. And strong earnings, i.e. profits. When profits exceed expectations, which they usually do because analysts perversely always undershoot their forecast, and then the market goes up. Is it a conspiracy? Well, that would be a criminal offense if all the analysts on Wall Street decided to do that collectively. Whatever the reason is as to why analysts are so poor at forecasting profits and companies are so good at managing them every single time, and I've written about it in my Financial Times columns, and we haven't really got an answer to it yet. The academic research hasn't even found an answer to it. We can all guess and speculate. We're not here to do that as to what it might be. But anyway, they see a 20% upside in the case of Wells Fargo. It's a good backdrop. Now, you might say, oh, well, do the opposite of what Wall Street's saying. All I'm saying to you is not that. We're not here to trade. What I'm saying is we're investing, and that's the backdrop and the headlines. I'm relaxed. I'd have to be relaxed anyway, even if the headlines were pessimistic. In fact, if they were pessimistic, I'd be over the moon because it would mean I might be able to deploy more capital as it comes in at cheaper prices. But it's a good backdrop. No stock in history has had more influence over the S&P 500 than Nvidia, and I'll show you the data to back that up, what that means. This is all CNBC headlines from today. What could go wrong? Well, I'll come to that in a second. The point of that headline is this. The S&P 500 is capital weighted, and it is the most followed index in the world, and trillions follow it. Okay, dollars, trillions of dollars back it and follow it. It's a benchmark. Exchange traded funds follow it. It's a benchmark into which big funds invest. Now, it is a large component of it is Nvidia. So if Nvidia misses profits or does something wrong, the S&P would fall. And the danger with that is it's single stock risk. Imagine you think you're buying the exchange trade fund, which is the index tracker of the S&P 500, but instead you're actually just buying single stock exposure. You're just putting all your money into Nvidia. You'd be worried, obviously, because it's just one company. As things stand, listening to analysts today from Piper Sandler, what they were saying is even selling what they're selling to the Chinese, it can't be reverse engineered. It's partly the software which is embedded in, it's partly the manufacturing. The Chinese are not going to be able to rip it off at a cheaper level. We're not talking about replicating computer games or making TikTok. It's a bit more complicated than that for now. Sooner or later, it'll catch up. I mean, the Americans invented nuclear weapons. The other countries of the world caught up. It will happen eventually. It's just not going to happen this year. So we'll come to that and the single stock risk. And of course, there's always risk. The simplest and biggest risk in the market is the past doesn't guarantee the future. Wall Street now sees three Fed rate cuts before year end. Well, hang on. We're in bloody August, September, October, November, December. So they see one a month, basically, pretty much one a month. That's nuts. By the way, when they say Wall Street sees that, how do you decide? Wall Street isn't an individual. The way they do that is through the futures market. Okay, so there's a way of sort of predicting what's being priced in. Anyway, that seems optimistic. What that's doing is fueling optimism that if interest rates drop, stock market will rise because people have more money to spend, more consumption, more business investment. Okay, money only enters the economy through three mechanisms. Government, essentially, government spending, consumer spending, or business investment. Okay, GIC, government, investment, consumer, right? Cut interest rates, and you should have an increase in all of those, albeit one can crowd out the other. The point basically being is markets get excited when interest rates, as a whole, as a general rule, are being cut. Unless the reason they're being cut is because there's severe economic problems on the horizon. That's why there is no absolute rule in economics or the stock market. But on the whole, that's pretty bloody positive for the market for now. Okay, nothing lasts forever, sadly, in stocks. Okay, now I'm going to show you something. I'm going to do a little poll because I like doing these polls. So I want to show you this. These are America's top chip makers. They're the public domain. So for those on my Great Investments program who get a bit jealous that I speak to the public, don't be. Revenues, there they are. Revenue growth. There you go. Net profit margins. Look at those net profit margins. Ignore Intel, which is a sad basket case for now. And I'm not bottom fishing for stocks. I've got enough ideas for good stocks. I don't need to go looking in the dumpster or the trash can. Okay, I'm fine with the others, for instance. Look at those profit margins. I mean, they can take a lot of hits to the face. It's ridiculous. Well, in the case of Nvidia, they've created a machine which is printing money. I mean, that's nuts. Imagine I said I've got a 55% profit margin. Those tend not to, in economic theory, they tend not to last. Profit margin should eventually be eaten away in perfect competition to zero. Why isn't there perfect competition? Well, one thing is intellectual property laws prevent perfect competition because they allow you to hoard private property, intellectual property, for instance. Anyway, looks like Nvidia are going to keep that for now. Can't go on, obviously, but I think we're okay for the moment. Now, those are some good names there. That's all I'll say. I'm not going to say any more on those for the moment. Now, this is from Bloomberg and Apollo. Apollo, where my brother-in-law works. It just so happens. The weight of the biggest stock market, the biggest stock in the S&P 500. And remember, the S&P, and we'll talk about UK stocks in a moment. The S&P is based upon market capitalization. So the bigger the stock, the more influence it has. Now, at the moment, in 2025, Nvidia is the biggest company, and it represents 8% of the S&P by weighting, and its price to earnings ratio. In other words, it costs you $58 when you buy a share of Nvidia. You're paying $58 for every dollar of profit it produces. So what this is saying is, think of it like a house. You're buying a house. You're paying $58 for every dollar of rent you might be getting. You're paying $58 for that house. And you're only getting $1 in rent each year. It used to be you paid in 1994 for General Electric $8, and you got for $1 of rent, as it were, $1 of profit. So that's the point they're making. My God, AT&T, wasn't that an amazing purchase in 1980? Well, obviously not. In 1981, obviously not. Anyway, nothing lasts forever is one lesson from all of this. The other lesson is that justified? Well, valuation alone is not what moves stock prices. If it was, it'd be very easy. We just look for the lowest valued numbers and buy into those. Very simple. We know from simple data analysis that doesn't in and of itself work. Undervalued companies tend to perform better than overvalued ones. Growing companies tend to perform better than non-growing ones, and so on. So we want to look at a multitude of factors. All decision making is based on two simple things. What's important? How important is it? Whether it's who you marry, where you go for dinner, or what stocks you buy. What's important? How important is it? Valuation is important. Growth is important. Momentum is important. Cash flow growth is important. All of those things are important, not just valuation, which is what this measure is. Okay, so what does this mean? Well, I'm not going to read too much into it either way, because it's not the base on which I select stocks. I'll show you the base on which I select stocks. Put another way, biggest weighted constituents in the S&P 500 since 1999 to now. That's the weighting, and that's the PE ratio. So I've just put what you've just seen in a different way. Feel free to take photos of any of this. None of this is should hopefully give my clients a heart attack, because they should have seen it before. Bruce from Chicago. I love the Windy City. My sister used to work there. I did a road trip from New York to Chicago. I had no idea you cross. I think it's 2 time zones you cross, or is it just one? But anyway, it's a big ass country you've got out there. Took forever getting to her. Survey questions. This is from Goldman Sachs. Now I wanted to show you it because we're on the subject of those big companies. What is your view on the Magnificent Seven companies? Okay, so this is from July 2025. Goldman Sachs did this, and you can assume that they didn't just talk to Mrs. Smith from Leeds, or Mrs. Shah from Watford. They talked to clients who've got a lot of money to deploy. Current long, and we'll add, was around there. Current long, maintain. So these two aren't selling, okay? These are selling. Current short will cover, so they're buying. Okay, current short, maintain, not really influencing the market. Current short goes shorter, they're selling. No position will add, they're buying. No position will short, they're selling, but not yet, not participating, not making an impact on the market. So as you can see, most people are holding steady or planning to buy more, and those who aren't planning to buy more are cancelled out anyway. So it's not that bad in terms of the money. And you might say, well, wait a minute, since when does that move stock prices? It doesn't. It's just another piece of information which we'll throw into the mix. This is also from Goldman Sachs. I wanted to share with you. And when I can, I'll share these things. I've been invited to their Asian Business Leaders Conference in September, I think it is. It just so happens, this is where the sweet coincidences of life help. The chap I used to play badminton with, and before that was the chief executive officer of ICICI Bank in the UK, which is India's largest private bank, and invited me to join the board of, which I accepted, the private banking division of ICICI, went on to become head of Goldman Sachs India. Badminton partner. I mean, it sounds like golf clubs, doesn't it? So anyway, thanks to that, they keep in touch. And when I get information and data, I like to share it. I mean, why should the super rich have it? Investor bullishness on the S&P 500 US dollar, very simple. Bullish on the S&P, bullish on the US dollar. Okay, that's from one. I mean, you might say it's only Goldman's. Well, let's just assume this isn't fake and people aren't trying to tell you the opposite of what they believe. And of course, their views could change. This is from JP Morgan Asset Management. Return after economic and geopolitical shocks. Bottom line here is everything from Gulf War I, thanks to that, American president, Asian bank crisis, Russian default, thanks to that, Russia, 9/11, thanks to that, Osama, Gulf War II, US president, Lehman Brothers, America, Eurozone, Europe, US debt downgrade, America, Brexit, racists. I'm only kidding. I always say that. Britain, COVID-19, China, Russia. So, yeah, and they're sort of blaming the Indians for something. Anyway, for all of those shocks, they work out well for the stock market. Look, 3-year return, market's up. 1-year return, it's usually up. Usually. But it's only 3 years, it's up. In other words, give me another shock. Sadly, Trump's not able to manufacture a shock to the system. You might think just his being president is a shock to the system, but no. We haven't had a proper shock because the stock market's already at all-time highs, and the man's only been president since November, which of course is all down to him. Forget the Nobel Prize for peace. I'm surprised he's not saying he should win the Nobel Prize in economics, because it is at all-time highs, and he's not managed to mess it up, which is pretty good going. I mean, politicians, we don't have much trust globally in politicians, do we? So, he's added a few trillion to the US stock market. I mean, took us down first and then brought us up. But hey, the guy likes doing stuff like that. Anyway, on a serious note, my point being, people are optimistic on the FTSE. Let's see how they are on the US markets by the end of the year. My point being, if we get negative shocks, don't panic and don't get bored. What that is telling you from JP Asset Morgan and what they're telling their wealthy clients, and remember JP Morgan is the biggest bank in the world, is don't panic, don't get bored. They might be saying buy some more even. Okay. 1 time zone, Bruce has said. Now, I want to show you something. I love this. Again, from JP Morgan Asset Management. I like to share, look, I could show you the 500 slides that they send, but you'd get bored. I'd get bored. I like to pick out the most interesting ones that they send their clients. And it's this, 10-year annualized return of the S&P 500 is 15.6% in sterling terms, okay, in sterling terms, for the S&P. The FTSE All Share is 6.2% over 10 years. That's less than half the UK. And that's not over 1 year, that's over 10. And I sort of started plotting, well, what does the US do? It won. It came third. It won. It came a bit low down. It won. Came low down. Ooh, bottom here. And then came second. I mean, as Trump might say, and I can't do a Trump accent, I wish I could, we're just tired of winning. They just keep winning. And that's 10 years I'm showing you. Actually, if you go back further, it's even longer. Even before Trump was president and could take credit for all of this. But it is extraordinary how much money they make. And I guess Warren Buffett put it well. He said, look, I was just born at the right time. Is why I'm stupendously rich. He goes, I'm not particularly clever. It's just that how could you not get rich if you didn't panic and get bored? So let's have a look at this one. Something else important I want to show you. The S&P 500 net profit margin. This is the ability to absorb tariffs, you could say. Net profit margin, 12.8%. Now, in the UK, I think generally, I looked at this a few years ago, it was about 10% or less, the net profit margin. 12.8% is pretty healthy. I mean, that's not taken a hit I mean, you might say the data is not up to date. Some of these are projections. Come on, Alpesh, 12.7. It might take a massive slump. Who knows, because of the tariffs. There's a lot of resilience there, is all I'm saying. And should there be falls, don't panic. Don't panic is what I'm saying. By the way, very quickly for your children who might be interested in getting into hedge fund, this is all free, and I've created on my site. You have got a ton of resources which I keep adding to on my best advice on careers. All of that, in case you do not know where to go, it's on alpeshpatel.com/links. Okay, so if you go there, you'll find all the resources, including that, the careers stuff. Okay, but I just thought I'd mention it because I've had quite a few of people's children message me. Actually, sometimes people mid-career messaging. Now, commandments of investing. I'm not going to go through each one of these, because we want to talk about the stocks and the stock market and the S&P and everything else. So what I'd like you to do is feel free to take a picture on this. These are like nothing you've read before, but I believe they're accurate. They're my commandments, but I believe they're accurate. I don't want to just repeat the same old boring tripe that you might have read elsewhere. Even if it's accurate, it's boring. When I was doing my Bloomberg TV shows, I've done about 300 for them back in the day. I had a rule, which is unless there's something original and insightful for me to say, original and insightful, I'm not going to say it. Okay, and I think with all of these, we've got quite a bit. So I might have to do a separate webinar on this and nothing else, just or a video on it. But anyway, take a picture and we can always discuss it on a different thing. But I think these are pretty good. Commandments are a good way of, well, to live your life, said Moses. This is what the rich do. This is what retail clients try and do for some reason. It's really weird. Retail clients love gambling and they think you're going to be right 10 times out of 10. Buffett, Soros, hedge fund managers, that's us. Bit of effort. We don't like putting a lot of effort in. We would not have gone into finance if we wanted to work hard for a living. I grew up in Leeds. Would have gone down the pit if we wanted to work hard. Okay, and the value, not too much. That's where we are. Now, similarly with stocks, it's why we have a portfolio and not just one stock, because if we could achieve perfection, we'd know just to buy one company. We can't achieve perfection. I don't have a time machine or a crystal ball to achieve perfection. So we're looking at a portfolio, and if that portfolio does well enough, think of it like a football team. My portfolio might not have the best goalkeeper, the best striker, the best midfielder, but I might still win the league. The same thing. Warren Buffett didn't have ever the best performing stock of that year. Whatever he held, he never ever, since he started, had the best performing stock of the stock market in his portfolio. Ever. Think of it. Yet he became the second richest man in the world. That's what I'm talking about. Retail clients think everything has to go up that you touch and everything should be in the top 10 of performers. With that, with the exception of the people on this webinar who are obviously with very good judgment, retail clients, other than you guys, are insane in my experience. Absolutely bloody nuts. Okay? Now, what we're going to talk about, we're going to talk about this. 10% improvement would mean an extra 25K on a $250,000 pension portfolio. You might say, bloody hell, Alpesh, you got the maths prize at school, did you, son? Must have been giving them away. Okay? Yeah. So let me put it another way. We created, amongst many other things, to show our approach. I thought, well, wait a minute, why not? Instead of just showing what we like based on value, growth, income, cash flow, Sortino, alpha, and why those factors, because they're the ones, undervalued companies which are growing, which the academic literature supports, tend to do well. It doesn't mean other ways don't work. You know, if you were Donald Trump Jr., there's a great stock strategy which works, which is call up daddy and get him to mention a stock. It works incredibly well in the stock market. So I'm not saying I've got the exclusive way of making money from the stock market. There are other ways, as Don Jr. will tell you. But I'm saying one way that works and it'll suffice. Okay. So one of the portfolios we have, the Quality 5 Plus, which is about 44 stocks. I thought it was 37, but it's actually 44 companies. And it's only one of, 20 odd different models. And why have so many models? Well, because people have different drawdown and risk appetites. Anyway, This is what it's done since 2017. Why not before 2017, Alpesh? What are you hiding? Well, because some of the stocks didn't exist before 2017, which are in there. And we could have removed those and then gone back even further, and it still comes up just as good. The point I want to make to you is this, right? 10% improvement. Well, why the hell are you getting 45s? Well, because some years you get 1% or 7 or 13. Okay, not great. Well, wait a minute. Did you know these were going to be big years? No, absolutely no bloody idea. In fact, I'll give you an example. I thought this was going to be an amazing year when 1% happened. And I thought this 2023 was going to be a really bad year. But it got 46. Well, wait a minute, you're an idiot. You don't know anything. Yeah, that's right. That's why I don't rely on my own judgment. I rely on the computer's judgment. Well, what's the computer doing then? Computer's doing this. It's crunching the numbers. All companies have, and before any of my clients panic and have an epileptic fit, this is not the filtered list. This is showing you the stocks which don't meet our criteria. Okay? Deepak, if you're watching, take the Valium. Value, growth, income. Okay, none of these meet our criteria. None of these do. Undervalued companies, which are great. Cash return on capital invested is from Goldman Sachs Wealth Management. Companies which are green means they meet our minimum criteria, but you need all these factors to be green. Okay, so none of these meet the fact that, oh, there was one just there. Nope, 6. Sorry, isn't there. And the volatility over 20%. Don't like volatility over 20%. Why? Well, because I don't have to have volatility over 20%, so why the hell would I want it if I don't have to have it? The reason we do it this way is, first of all, academic literature, that backs this up. Eugene Fehmer, Daniel Kahneman, Richard Thaler, Goldman Sachs Wealth Management research from their R&D division and Deutsche Bank, who both use Croakey for stock selections. Momentum from the hedge fund industry, Sortinas from the hedge fund industry, high average returns, low downside risk. Okay, very simple. Is because companies have 3 sets of books: balance sheet, cash flow, and profit and loss, and that's all in there. Okay, and you really need to go through 10,000 companies if you really care and love your family. If you don't love your family, hey, that's fine. Go pick your stocks off from a journalist on a tip sheet. Okay, and go do that. But if you love your family, then you probably want to do a bit more due diligence. Even after all of that, we don't know which year is going to knock the ball out of the park. Why? Well, because there's factors like what Donald Trump might tweet, which can't be incorporated. We're not looking for certainty. That's why we don't have just one company. We have a portfolio. In this case, 44 companies. If we were that good, we'd only have picked one. In hindsight, we know what the one is of each year. Okay, so just so you know. And by the way, this is just buying and holding. This is not trying to be smart and saying, "Ooh, daddy bear, let's exit here." This is falling asleep at the wheel. So this is the worst case. Worst case. Best case is you might buy in and out. You might not have all 44 and so on. So this is the worst case. So what are we going for? Well, what we're going for is this. We want, when we do that, to halve that number and double this number. Okay? And I'm explaining some of the ways in which this is constructed so you get a proper, deeper understanding of how you should be investing for your children and for yourself. Why do we halve this? Well, it's probably good psychologically, mentally, for you not to be over optimistic on the upside. And why do we double this? Well, it's better psychologically, emotionally, not to be over optimistic on the downside. So we say to ourselves, well, what if, and these don't matter, drawdowns don't matter. I'll tell you why. If you're not about to exit everything within 12 months, then it's a bit like your house price. What the hell do you care if somebody keeps knocking on your door every day and saying, hey, house has gone up today, gone down tomorrow, gone up today, gone down today? They do that every single day. And Warren Buffett gives this example. So what happens? One day he turns up and you go, bloody hell, compared to what he said a year ago, it's down 10%. I know, I'll sell the house. Nobody ever did that. Okay. The point with the drawdown is if it's during the duration of your holding period, what the hell do you care? I mean, I've got some people who are so insane, they will say to me, it's gone up today, it's gone down today, it's gone up today, it's gone down today. And I say to them, you don't need to worry about the long term because you're going to have a heart attack within the week anyway. You'll be dead. Just make sure you've bumped up your will and your life insurance. And here's my address to which you can make me a beneficiary. Honestly, they're going to kill themselves. So in a way, this is just to stop them panicking when it happens and exiting prematurely. Why halve this? Well, in the 1980s, my uncle used to say to me, and like I said, I was born and raised in Leeds, and it was the same, I think, for the rest of Yorkshire. My uncle used to say to me, if there is a recession, house prices will double in 5 years. And if there isn't, it'll take 3 years. Whether or not there'd be a recession was certainly out of his hand. If you remember the 1980s, thanks Nigel Lawson and all the rest of it, God was up and down more often than there's a rude joke in there. But anyway, it was up and down a lot. The point being, I'd rather just assume we're not going to get the best of times. Now, 15% per annum just happens to be the longer term average, as you've seen for the S&P 500. So I'm cheating. I'm just saying to you what happens in any event with background radiation noise of the market. And that's doubling your money in 5 years because that's mathematics. I'm not doing anything clever. The cleverest thing I'm doing is saying don't get bored and don't panic and have companies which are good. This is the quality 5+ buy if you want to see a sort of a breakdown year by year. Now, I want to show you something with any portfolio. Wait a minute, Alpesh. Why the hell have you got stocks which some years have dropped 28%? Some years have dropped 64%, 26%. In fact, some stocks have dropped 50%, 39%, 50%. You've got stocks in there which have dropped about 50%. A whole bunch of them went down. What kind of portfolio picking is that? Well, you should be worried if they only went up every single year, because that would mean some kind of cherry picking. So what we do is we don't look at the historical returns in order to determine what should be in the portfolio, because that would lead us to cherry picking or curve fitting or basically statistically lying to ourselves. What we do is we look at this first. We look at value, growth, income without having any conception of what happened in 2017, 2018, 2019, 2020. We look at this and then we say, let's just see how it's done previously statistically, okay, and making sure that fits. That's to avoid that curve fitting, and we still can't guarantee the future. We then break it down month by month, and my point I want to make to you is, if you panicked or indeed got bored when you had that, or got bored when you got this, so write it down: panic plus boredom equals poverty or idiocy. Pick whichever one you want. Then the reason I show people this is to say that is going to happen, but you can only afford not to panic or get bored if you've decided you're not going to speculate. If you want to speculate and gamble on narratives and headlines, as I showed you earlier, then feel free and go play with hand grenades as well if you wish. I want to show you something else which is very important. Now, we've created this. This is ours. I'm going to make it available to the public completely for free very soon, possibly this week. Imagine you're 50 and you want to retire at 60. And let's say you've got 400,000, and this can be pounds or dollars, it doesn't matter. And let's just assume you're not putting any money in and your employer's not putting any in, and assume you're just averaging the S&P 500, okay? And that's inflation. This is what happens. Your final pot will be 1.2 million in today's money. That allows for inflation, or it'll be this in nominal terms, okay? That's what happens to 400,000. It gets to 1.6 in 10 years. That's what you want to do, obviously. All good, all fine. I want to show you something interesting. Look at this number here, the annual fees. Let's say you're with St. James's Place or somebody like that. So we tried it with 0 annual fees. Then we changed it to 2% annual fees. And you went from 1.2 million to 1 million. In other words, you lost £200,000. Now, here's where it gets interesting. What's 200,000? Well, it's 50% of your original pension pot. Hang on, Alpesh. 2% annual fees meant I lost 50% of my initial annual pot. Yeah, well, I don't care about losing 50% of it. What about my end balance? Well, compared to 1.2, you had 1. So you lost 20%. 20%. You had 20% less because of those fees. Guess what sounds more reasonable? 2% sounds a lot more reasonable than 20% fees, doesn't it? If St. James's Place said to you, we're going to charge you 20% fees, you might say, F off. Guess what? You're going to be with them for about 10 years, or whoever else, wealth manager. I do want to show the maths on this. I didn't know the maths on this until I looked at the maths on this. I mean, I knew in general terms, ooh, that looks rough. You know, it's going to be bad. I didn't know it was going to be this bad. Just done for fun, just to show you. If you want to pay £200,000 to someone over 10 years, well, I can think of a few good charities you might want to give it to. 200,000. By the way, none of their funds have done this. And I'll guarantee you something, in 10 years, none of them will do that. How can I guarantee it? Warren Buffett did the same bet with a bunch of fund managers and won. Okay, so it's here. Somebody said, can't hear, I can hear now. Sorry, I don't think it's me. I apologize if it's me, for the audio for some reason. I don't think I've done anything. But sometimes computers can be a bit mental. Let me just turn off extra stuff. Yeah, okay, I'll turn off. Right, here we go. So, this is not an endorsement for either free trade or Hargreaves Lansdown investors. All I'm going to say is, when you speak to a broker, whoever you're going to use for your SIP or your ISA, what I suggest you do is, if you've got a typical investment size, maybe it's £1,000, maybe it's £10,000, whatever it is, call them up and ask them, I want to buy 10,000 or 1,000 of XYZ stock, and ask them what the fees are. The reason I say that is because it'd be bloody difficult for you to work out. But secondly, look at how complicated it is. You've got that fee, then you got this one, then you got that, and you got this, you got that. Okay, so I just wanted to give you a heads up on it. To me, they're much of a muchness. Now, by the way, feel free to put in the chat box if any of you found really good brokers. More than happy to share that. AMD, Mandeep, I like. But how does that help you? I mean, let's put it this way. I don't think you're making a stupid mistake having it, but the most biggest danger with AMD you're going to have is panicking, of which there'll be a high likelihood you'll do it because it'll be volatile. Okay, AMD could easily fall based on its volatility numbers, 15, 20% in a month. And you will panic and exit. And you'll have sleepless nights. So do you see why it's not just about what do you like, what do you think of this, what do you think of that? I don't know you. One thing I do know is you're human, because I've got no AI on here. And that being the case, you're prone to panic. Okay, you might think you're not. Trust me, we're all armchair generals when it comes to investing. But I'm just going to turn off the, if I can, pause syncing. Sorry, there's some of my OneDrive folders are syncing. So if I can pause the syncing on these, that might help you being able to get the audio better. I apologize for this. I normally get this done beforehand. There we go. That should help the bandwidth. For those who don't know SIPs, and this will be the same for the Americans as it is for the Australians and the Brits, is all of this. The bits which are in my son and my wife's pensions are that. Never ever this, because as I've written and as Eugene Fama got a Nobel Prize for showing, that is rubbish. That is a scam. It is a con trick. They will advertise like crazy, and it's legal for them to advertise investment trusts. And I will always win a bet that whichever investment trust you pick, it will not persistently outperform the benchmark it sets itself against. How do I know I'm going to win that bet? Because statistically, I always have. Okay, not my specialty. REITs, I stay away. Bonds, that's easy. It's just Flagstone or HSBC or whatever. Bank account interest. I get about 4% at the moment on my corporate money. Individual accounts, I'm not so sure. Okay, ETFs would generally for me be leveraged single stock ETFs. Don't do that. I'm not going to talk about it here because that's higher risk. Okay, and as you will know if you've read my Financial Times column since 1999, I tend not to do UK stocks other than for commentary purposes for the public, and sometimes like Brexit when they're just at a bargain because pound collapse, I could sell my US dollars, buy a ton of UK property stocks and then sell them out 6 months later. That was an exception to the rule. Generally wouldn't do it. Liz Truss as well. Thank you very much, sweetheart, for crashing the pound. Now, this is not an advert for free trade. I've got no relationship with them. I'm just showing you this button all brokers have. People say to me, how do I move from one to another? If you so wish to move, there'll always be a transfer button and the brokers do it for you. Simple as that. All brokers will have that button and they'll transfer your pension for you from wherever it is now to wherever they are. Okay. Now, Path A don't do this. This is retail clients. They always do this. Bit more professional. And we're going to come to the stocks in a second. Sorry, I've taken a bit longer than I anticipated on this. Path A is what you guys do. Retail clients do. Stocks drop, panic sell, market recovers, miss the gains, permanent loss. Put your hands up if that's happened to you. Everybody's hand will go up. Obviously, I can't see into your living room, except for you, Bruce. I can see into yours. But everyone else's, I just can't see into it. So we'll assume that a lot of hands went up. Path B, you've got this. Stock drops, well, there's market recovers, long-term gain. That only works if it's a quality company. Otherwise, stock drops, it's crap, it stays down, gets knocked out. It's like somebody competing with Muhammad Ali. You're staying down, baby. Path C, you buy, stock drops February this year, for instance. You sell as an insurance policy against further falls. Further falls don't happen. You might have to buy back later, possibly higher. That's fine. Control risk, that's the price of insurance. My house didn't burn down this year. Am I an idiot that I didn't foresee that it wouldn't burn down, given that my house has never, ever burnt down? Neither has the house of anybody I know, and yet we've all got fire insurance. So are we all idiots? No, we're willing to pay that insurance policy. Okay, it might be mandatory actually if you've got a mortgage, but let's say you haven't got a mortgage. Still, everybody pays the damn thing. Why? Ridiculous. Well, that's what we do in the stock market occasionally. Don't want to do too much of that because you might end up trading. So for me, it's something we call the daddy bear rule. If it hits, I want to be taking out insurance. That's just me, because at 54 with a young son and a wife and elderly parents, my number one job is not to mess it up. So when I get people saying, hey, I'll just copy your portfolio, I'll say, like, hell you will. I'll go in a Formula One car and drive off a cliff. Are you going to do the same? No, you haven't got the balls for it. Neither have I, for that matter, but it's to make an extreme point to them. Okay, so where are we at the moment? Now, when I did this chart, we were here. Where's that? It was roughly at 0.2 becoming 3. We can write this down. And by the way, again, clients, don't have a heart attack. This is in the public domain. It's in my books as well. We were at 2 becoming 3, and you can read what those are. Okay, which is roughly, what's that, February to March? Then we went through 4. So you're probably wondering, where are we now? Well, the earliest you could have bought is 5, as I've written there. Okay, we've gone through 5 now. 6, we've gone through 6. We are at 7. What comes after 7? You think it's 8. No, it's not. 1 comes after 7. So we've gone from 7 to 1. What comes after that? 2. Okay. This bit, sooner or later, that's going to happen. It always does. 100% guaranteed. It always does. I just don't know when. That's why I do the broadcast twice a week. I'm not trading or gambling on it in any event. All I know is we're at the moment, we're at between 1 and 2. We'll keep watching. Oh, here we go. That's useful, Alpesh. This is brought bang up to date. Where are we? Well, there, look. We're like it was here. I used to do this on Bloomberg TV back in the day. When I was doing the show, the presenter wrote the auto cue and put the graphics up onto the computer system and fired the Renstons, little graphics which you'd see on screen, through a button and operated the auto cue with a pedal. Then eventually we got a director in the box and a producer and all the rest of it. But initially had none of that. Well, you still had a director who'd sort of move from camera 1 to camera 2 and tell you when you're on air. But you didn't have the producers doing all the firing up. So I put this up. So exact same chart. I mean, as in this company didn't exist that produced this chart, but the same principle, S&P 500, MACD, moving average, convergence, divergence, which measure short and medium-term prices. And I'd make the same point. So it's the same point I've been making 25 odd years. Okay, where are we at the moment? We're here. Does that mean we're guaranteed to fall? No, because if anything in the markets was guaranteed, I'd be the world's first deca-trillionaire. Okay, and I'm not. So it's not guaranteed, but you can see where we are. And people say to me, so what does this mean? What does it mean? When's it going to happen? When it's going to happen, I do not know. By how much it's going to fall, I do not know. All I know is today I'm holding. That's it. That's all. Don't try and over predict. Retail clients have this terrible, terrible habit of trying to over predict the future and read more into data than is available. Nassim Taleb's famous book, Fooled by Randomness, is an illustration of how and why they do so much of that psychologically. Maybe it's survival, but whatever it is, stop it. All you know is today is not a reason you need to panic. You're not trying to be perfect and pick the exact tops and bottoms. For those of you who are trying to do that and trying to be right 100% of the time, you should actually donate your money to charity because you're not going to keep it very long in any event. Okay, you're nuts. Instead, that's where we are. Now, what can I tell you about that? Well, most I can tell you is probably going to fall at some point, gradually, slowly. It'll give us ample time. It might do this again, like it did in February of this year, where we got out as an insurance policy against deeper falls because we were afraid of this happening and had to buy back. That's the cost of insurance, a little bit higher. Fine, cost of insurance, good night's sleep, no worries. At least I avoided that whoop-saw. Or it might just keep going up and up and up and up forever. We honestly do not know which is going to happen, just as we didn't know during COVID that it's going to be a V-shaped recovery, which does this. All I know is today, living in the moment, not panicked, will continue holding. Might today be the top of the market? Of course it might. Who's coming out with earnings? Nobody important, I'm afraid, in the sense that none of these will move the market or change market sentiment. Palo Alto Networks, the CEO is a friend of mine, Nikesh Arora. He was on the board of a company I set up in the UK. I think I've mentioned this before. Nikesh was on the board of the UK chapter of the world's largest entrepreneur mentoring organization. I co-founded the UK chapter. Nikesh joined our board, and then T-Mobile sacked him after a while. And here's an inspirational message for all of you. And I think he was on about 100K a year for T-Mobile. Anyway, we all thought, because he's mentoring entrepreneurs, he'd go into entrepreneurship. Next thing we hear, about a year later, he is number 4 at Google. He did the interview with Sergey Brin and Larry and got hired, and then moved to SoftBank and now is CEO and is a billionaire from the deals and all the rest of it. Nice bloke, but there's hope for all of us to become billionaires is all I'll say. And that's doing well. He knows how to keep a stock price up. He was number 4 head of sales at Google, so he knew a bit about how to get the marketing just right. Okay, and the messaging, and that's what Silicon Valley and the stock market is about. Get the messaging right and keep the stock market elevated. Get the stock elevated for a bit longer. Anyway, that's not a stock recommendation. I'm just saying it's an important company to keep an eye on. Cybersecurity. Past week. So let's talk to the past week. Sorry, I've gone on really longer than I anticipated and all of that. I just can't get the timing right, can I? Past weeks look like this. Forgive me if you think I've rambled on too long. Okay. Sarah, we don't modify them because then we'd be trading. But we do have different models that we can create each new year. If somebody said, no, I don't want something that you made 3 years ago. Don't give me stale stuff, even though it's producing great returns. Give me something new. We can create new models. So past week, we've got about 20 different models. We could create an infinite number of models which do well just because there's an infinite number of permutations you can have. So past week, where are we? Well, that's done well at long last, hasn't it? Don't read anything into 1 week alone. Healthcare's taken a bit of a hit. This is why you don't have single stock risk. Now, it's in the public domain. So again, clients don't have a heart attack. I'm going to disclose that. They'll know I continue holding JP Morgan and Goldman Sachs. How about the past year? Well, thank you, JP Morgan and Goldman Sachs. And you'll also, I'm sure, it's in the public domain. It has been for a long time. I'm not disclosing any secrets. People will know I also own the 2 M's and the 3 A's, Meta, Microsoft, Apple, Amazon, Alphabet. Okay. So where are we on some of this stuff? Over the past year, this is where we are. Amazon, Alphabet, Meta. Would I have been better off not having Apple for the past year? Well, in hindsight, yes. But hindsight's a wonderful thing, isn't it? And would I have been better off not having exited Nvidia and then bought back in, not having exited in February and then, or was it March, and then bought back in May? Yeah, I would have been better off because I had to buy it back at a higher price, the daddy bear thing. But it was an insurance policy against steeper falls, which I was willing to pay. Some clients didn't take the insurance and did better. It's a bit like this year. If I don't take the house insurance and my house doesn't burn down, then am I going to think, wow, aren't I clever? Didn't burn down. Of course, once my wife stops slapping me for doing that, I'll think, aren't I clever? Past year has looked like this. So the Nasdaq's up 28%. Okay, UK and US, S&P and the UK at 20, which is unusual because the UK doesn't normally do better than the US. It's not doing better than Nasdaq. Now, I want to show you the stocks or the market can do four things in any given year. And this, again, is where retail clients don't understand it and get it wrong. Okay. Raj is absolutely right. Well, seeing what happened in 2022 is exactly why I paid the insurance policy, because in 2022, the house burned down. And that's why I didn't want to do it. So I paid the insurance policy. I'm happy to do so because I'm of that personality, which is I'd rather have a good night's sleep. At my age, you maximize, look, as you get older, you want a good night's sleep. In your 20s, it's like, hey, let it ride, baby. If anybody ever speaks like that. So what are the four things the stock market can do? Well, of course, it could just keep rising, which is what people think magical people with lots of degrees like me can see into the future and do. No, we can't. And we can't do that. But the market can do one of four things. It can either keep going up. So that's the first thing. Second thing is it can go up and then take away all your gains again. Two, not nice, is it? Don't like that one. Yuck. It can fall. Three, don't like that either. Yuck. Or it can just go sideways for very long periods of time, like there. Four, don't like that either. In other words, it's only 25% of the time it actually does what retail clients seem to think gurus and pundits, two very popular English words, gurus and pundits, wonder what the origins of those words are, can see into the future with their time machines and will always deliver. No, get used to the fact that 75% of the time you're going to get 2, 3, and 4. So don't panic and don't get bored. Okay. Again, for clients, this is not confidential. But okay, so there you go. Nice. These have been the top gainers. It's not every week that my holdings might be the best ones in the market, but it's nice when it happens. In fact, it's a rarity. As I already said, Warren Buffett's never had a stock which has been the best performer of the year in the stock market. Statistically, it'd be very difficult. UK, these have been the best ones over the last 7 days. However, having said that, I'll do a separate video on UK companies rather than go into it right now. Where's the Nasdaq? Well, that's where it is. So the Nasdaq in 2020 was at, what is that, about 180? Now it's at 580. So from 180 to 580. Now, if you're American, you may well have been tracking this because you tend to track your domestic market, in which case you've gone from 180 to 580. If you're British, well, let's see, in April of this year, you too were where the American was in 2020, except you'd had 0% return. Of course, it's now got a bit better, but you were at 0% over the period the American had done significantly better. It's not that the Americans are cleverer. No offense, Bruce, have you met them? They're not cleverer. An American passport or being born in the land of the free and home of the brave doesn't make you cleverer. What it is that they've got an incredible stock market. And pensions tend to track the market, and so they get richer and richer and richer. And there's a few other benefits alongside it for the Americans. Size of the economy, size of all that agricultural land, that was bestowed and bequeathed to them by the Native Americans. It's just incredible, the wealth that they can create, which we can't. It's not because British people are more stupid or anything, okay? It's just we don't have the same advantages. Tiny little island, for which it's got one hell of a footprint on the on history. But that all aside, it is just simply that you've got a tailwind, which is incredible, whether it's the Nasdaq or whatever else. So let's go into some of this stuff. I'm not sure why that slide's there. Okay, remember, halve that, double that. So let's see what that happens. I want to draw a couple of points to you. Look at the volatility in returns. Look at that. It's not consistent. That's when panic and boredom sets in, as I have said. And these things are not guaranteed by any means. Let that sink in. Not guaranteed. Panic, boredom. People think it's guaranteed. Oh, no. Oh, soothsayer, guru, pundit, you must have a time machine. Tell us. I honestly do not have a wiretap into the Oval Office. Now, this is how you sack your IFA. Feel free to take a picture. It's a letter we've written for many clients. Get your camera, take a picture or screenshot if you know how to do it. This is how you sack them if you're with St. James's Place. Okay. That's what you say. It's what you write. Just in case, Bruce. Sorry, Bruce. I love Americans. Okay, take a picture. You got it. Now, this is the life-changing slide for me. Goldman Sachs, Jim O'Neill, now Lord O'Neill, invited me to a lunch at their offices with about 20 other hedge fund managers in 2000 and whatever then. Okay, this is their quantum database, Goldman Sachs Research. Okay, Goldman Sachs Investment Research. Sounds very important. Anyway, what they found is 30% per annum is what companies in the top quartile by cash return on capital invested do. So we wanted to tick that box. That's it. Don't read more into that. Doesn't guarantee you're going to get that return. Doesn't mean every stock in the top 25% by cash return gets it every year. Got it? Retail clients have a habit of reading too much into it. They'll want guarantees. Don't exist. It just means the odds are a bit better in your favor, just as chances of you losing weight are a little bit better if you don't eat tons of chocolate. Sounds incredible, I know. Okay, similar kind of thing. Holy Grail for us then became that. That's the Holy Grail. I'm not sure why I've given it a religious thing to it. Secret Vault sounds more exciting, I guess. Value, growth, income, cash return on capital invested, momentum, sorting out alpha, as I said, and then sifting through that. Ooh, that means that's finished already. I'm going to answer your questions. Ask me your questions. I will happily answer any of them on any of this. Oh, and I've got to give you a load of files. I'm going to share a bunch of files with you as well. Oh, and there's some websites I need to show you as well. So I have finished within the hour. Isn't that amazing? The websites I want you to have a look at, alpeshpatel.com/links. If you go onto there and then see all this, it's a public Telegram channel, LinkedIn, you'll find my articles and everything else. You'll also find a whole bunch of amazing stuff. If you point your phone to that little QR code, then what you will see is that on your phone, you'll be able to see all of this immediately. See, it's just there. And you could actually do that. Let me see if I can pull in a bit. There you go. Isn't that clever? Oh, they can do things now with technology. And let me also show you something else I want you to have a look at. So that's my LinkedIn page. Feel free to follow me on there. I've got 26,000 other followers, and on LinkedIn have called me a top voice. Ooh, nice. And you will see a bunch of articles and videos and all sorts of stuff on there as a result of following me. So there you go. On there. And that's all on alpeshpatel.com/links. And I'm going to also tell you where else you can find me is on my YouTube channel, for which I've now got. Ooh, it's right here. I keep it on my desk. It's the only thing my son's proud of daddy for so far. One of those little silver beauties. Okay, for the massive number of followers on there. So do follow there for a lot of free content as well. Any questions, or you want to get in touch, and hopefully you could see the files as well, let me know. If you want to be part of the Great Investments Program, I'm going to put up something for you lovely people now. I think, here we go. So feel free. And I always add a webinar discount of 40% for people on the webinar. So you can do that. And I want to show you. I wanted to show my YouTube channel, but I just bloody can't. I don't know why. Your switch accounts out, YouTube Studio, yeah, blah, blah, blah. It does everything except let you see your own channel. It just doesn't do that on YouTube. It just shows you the inside of it. But anyway, it's on alpeshpatel.com/links. Okay, I'm going to show you something else which I think is really cool. Oh, got 250,000 followers. I didn't know we had that many. Here we go. There you go. You'll get a bunch of free videos on there as well, actually. So 245,000 subscribers. That's good. And it'll take you through a whole bunch of stuff on there, including my TV appearances. That was just 2 weeks ago. That's nice. And a whole bunch of stuff, including this one, should go on there as well. Some are just 1 day ago. That's a day ago. That was 3 days ago, 3 days ago. So there's something usually posted pretty much daily, I would have thought. Some of them, I've stopped doing the elevator interviews, which are interviewing people in the House of Lords and so on. So I should probably get rid of that. And entrepreneurship ones less, so career clinics and so on, and shorts as well. But most importantly, so do have a look for more content there. I'm going to go back to questions to see if there are any. And what I want to show you is a poll that I'm going to put up. Raj, are there different rules for the quality 5 versus the other ones on the filtered list, for example, when to exit? Yeah, so the idea with the quality 5 portfolio is there's 2 approaches to investing. One is you can either just use the further filtered, in which case it's more for people who want to have total control. So 12 months or 25% stop loss. So time and fall limited, because they want to be more controlly, okay, and more on it. The model portfolios are ones where they're like, hey, mate, I'm a surgeon, I'm a bit busy, and you're really going to hold those regardless of falls for 3 years. No point holding it for 5 minutes. Equally, you're not going to hold it for 300 years, are you? So at least give it 3 years, a good amount of time. Okay, so very simple, and that's based on people's risk appetites and what they want to do, which is what we try and determine. Which platforms you use for Charles ISA and SIP and yours? It just so happens I use, there's several platforms. And the reason for that is I'm unusual because having written books on this, I like to have multiple platforms so I can trial and test them out. So Free Trade, Hargreaves Lansdown, AJ Bell, Interactive Brokers I haven't used but have got an account, okay, as well. And for longer term, outside of SIP and ISA, and for leverage, I happen to use IG Index, but outside of SIP and ISA for holding spread bets for awfully long periods of time because they're tax-free. Non-investments, what financial professional career do you think AI will replace first? William, I'd ask AI. It's the first thing I say to my wife about anything is, well, can you ask AI and not ask me? And it'll give you a brilliant answer, William. It really will. I don't know. I've stopped using my brain very often, except for these bits, because AI just answers everything so much better. Alpesh, what are your thoughts on recovery for BRKB? Thanks. Well, it's a brilliant question, Glenn. If it's part of a model portfolio, which it is for some of the model portfolios, not all of them, then you just hold it and you don't need to worry. Simple as that. And given it's a proxy for the broader stock market, don't need to worry. Simple as that. If you were trading it, then you might be worried here and there. But then I'd say don't trade it. Alpesh, how many stocks are in your model portfolios? No, for the Quality 5 Plus, it's 44. Other models have as little as, I think the least number we've got is about 15. But on the whole, assume an average of about 20. Okay, assume an average of about 20 would be the right number we would usually have in these. Okay. William, I think I've answered that. At what point would you take profits out of stock you have? Well, Dave, if it's a model portfolio, you'd keep the whole model. So in the same way you're not getting out when it drops 70% on something which has been generating 30% per annum, Similarly, you're not getting out prematurely. But what I say to clients on that is, which is why they have unlimited access to me forever, is let's deal with it when it happens rather than a hypothetical beforehand. Because there might be a reason, say with an Nvidia, that you're not getting rid of all of it, but you're rebalancing. Let's say Nvidia became 90% of your portfolio after a year, for argument's sake. You might say, do you know what, Alpesh, I've only got one stock. It's all bloody Nvidia because it's gone up so much. It's 90% of my portfolio. So it's not that you're taking profits as such as rebalancing, and that's more likely to happen. And rebalancing you do every year because historically that's the basis on which the models were derived. An annual rebalancing back to their percentages at which they started the start of the year. Do you see? Okay, and you need those kinds of rules. Otherwise, how do you replicate the model? How do you replicate something going forward? Because if you said, oh, I'll change the rules going forward, or the historic rules can't be reused in the future, then you couldn't actually say that history has any use at all. I don't like the current drawdown. Well, Clint, if you don't like the current drawdown, it usually means one of two things. Well, one of several things. And this is really important for everybody. Let's say you've got a stock and you don't like the drawdown. It could mean that it's a rubbish company which has suddenly changed its fundamental. Let's assume that's not the case with Berkshire Hathaway. Okay. There'll be lots of noise to make you fear that, like, oh, Buffett's retiring, the new guys have got no idea. His system and approach is pretty bloody simple. A buffoon could do it. In fact, he himself said a company should be so simple an idiot could run it, because one day an idiot will. So he's already engineered and hardboiled that into the system, that an idiot could run Berkshire Hathaway. And by the way, there's only 14 employees in Berkshire Hathaway, just so you know. You might be surprised, but there's only 14 members of staff. Okay. And if you look into it, there's only about 3 eligible to run the bloody thing, and none of them are buffoons. They're not particularly, they're not Nobel Prize winners. They don't need to be. Anyway, so let's assume it's not that. So what's happened is either you've put too much money into it, or you're not aware of historic moves. Berkshire Hathaway, in its history, has dropped 50% 5 times. I think it is 5 times 50%. So either you're unaware of history that this thing happens, or you've put too much money in, or time, you needed the money tomorrow. That's why you're panicking. So you're either panicking or you're bored, and those are the reasons you would be panicking or bored. So what I'd say if you're a client of mine, which I don't think you are, because you haven't reached out to me, is, well, there's no reason to panic if of what I've told you applies, which it does. Okay, so that should explain things. Okay, I think we're done. I think that's everything. For those who are interested in the Great Investments Program, reach out, get in touch. Happy to give you a tour. Don't forget to have a look at all the free links. I will put those in the chat to everybody. Let me know if you want to see more of stuff. I'm sure you look, I show you some of the stocks I own, my wife and son own, as I've mentioned in this broadcast already. I can't show every single one that's in the Quality 5 Plus or the other models, or indeed which meet all our criteria, because otherwise Deepak will go nuts. He'll go absolutely insane and skids. Okay. But none of these meet our criteria. Now, that's not to say they can't go up, but the major problem is private investors have a lot of companies which will be overvalued, not growing, producing no cash flow, and lo and behold, drop 72 bloody %. Okay, time and time again, and are very volatile and give them throwing up disease. Okay, so we're just trying to avoid doing stupid things. Doesn't mean these are all bad companies which can't survive. Of course they'll all survive, otherwise the world would be in trouble. It's just we're just trying to avoid doing stupid things. Thank you, Glyn. No, history is very important. William, you're very kind. The famous phrase about Goldman Sachs, who said it of themselves. It's interesting. You should put it in those terms, William. I'll tell you why it's interesting. I couldn't create a Jeff Bezos size foundation. The one thing I've got, which I can give people, isn't money. I can't just wire money to you. Okay, I'm not Bill Gates. But what I can wire to you is education. And if I can wire education to you, that will compound. And so I created the Campaign for $1 Million, which is a free campaign to teach 1 million people how to, through better investing, add an extra $1 million to their pensions and investments. That's the goal of it. That's on campaignfor1million.com. That's all I can do. I mean, I'm not good at, I wouldn't be good in the Red Cross. I wouldn't be good as a medic, saving lives, or as a surgeon. The only thing I will be useful for, other than to my family, I'm pretty reasonable at stacking a dishwasher, but says the lady who actually does it. But the point is, I'm good at teaching people this stuff. And so it gives me a bigger purpose in life, and that's important as you get older. And that's why we created this, to share the data and the information and the education. And it gives me one hell of a dopamine hit when I get nice comments. Anup, my pleasure. Well, do you know what I do? Recently, I was in Spain, and people said, "Oh, you're on vacation." I said, "I never take vacation." What I do is, before my son wakes up, I work for 3 hours. Before he wakes up and after he goes to bed, because these are the hours my wife keeps as well. She rises with my son and she sleeps at the same time as him. So after he goes to bed, which was an hour ago, I might do a few hours. And it works out quite well. It took me this long to get to that stage in life. Works out quite well. Thank you all very much. I enjoy it. I love sharing my knowledge. It is, as you become an old man, Anup, all you want is people to listen to you. Just ask, grandparents and the like. So I've been very lucky. I love this one from Paul. Absolutely bloody love this. Makes it worth it. And the great thing about the internet is you can put it up there. People think, "Oh, you're doing it to show off to us." No, nobody else will look at this except me, probably. But it means I've got a record of Paul was bloody happy. Never met Paul. Sorted. That's what life's about. Or I guess you make life about whatever you want to make it about, but for me, it was about that. For those who signed up, thank you very much. I will be in touch. For everybody else, feel free to email me at any given time, any questions. And as you know, I've got a ton of free resources. Don't forget, for those who want the free resources, alpeshpatel.com/links. But one of those is all this free educational information, including free copy of my book, which is, all this is free. All of this is free, okay? So if you don't use it, give it to your kids. They might find it, okay, handy. But yeah, you don't have to read all of it, but I think that's my life's work. It's all on there, and it's, if I say so myself, very, very good. And I'd say, if you look at nothing else, something that I haven't done, Steve Akelis, Charting from A to Z. Have a look at that. It's really good. You've got the whole book there. Okay. There's a few other books as well on there, which are rather good. This is more if you're going to get a career and you want to know what the exams look like in our area. That's an amazing book. Peter Thiel's 0 to 1 and the Intelligent Investor. Okay. Thank you very much. And thank you all. As well, my sense of humor is terrible. Thank you all. I'm going to go now. Bye, y'all.